Corey.
Yep.
And I think, it's something that is, you know, is growing in terms of popularity with people reattending these live events, right?
Oh yeah, absolutely. I guess after COVID lockdowns, for the kind of the word on the street was people were happy to be out and about. That was certainly something we saw. The digital versions are great, but nothing like shaking hands and seeing people face to face.
Yeah, what's really interesting is that there are obviously a lot of new faces, but there were also a lot of old faces that we've seen, maybe at trade shows for the past 10 years. And I really love that because it basically, is a reflection of, people's ability to survive and thrive through, different market conditions. They didn't give up. They're still trading and they're still here.
Absolutely, absolutely. Yeah, I saw a bunch of old friends. I used to attend this show at a previous post years ago. So last time I was there was probably 7 years ago, and I saw a bunch of people from that time. So yeah, absolutely, people were going for decades on end to these shows. So it's great. Looking forward to attend many more.
Yes, yes. And we can talk about a little about, what I found really interesting, Corey, was that Boris and I did 2 sessions on prop trading. And they were extremely well attended, and so indicating that people were really interested in the prop trading product. But when we did a survey of the room of how many people actually knew what it was, let alone actually tried this, I would say it was probably less than 20%, which was unbelievable.
Less than 20% knew it or tried it. I think probably I would say 20%, maybe, no, 10% probably tried it, right?
You were there, Boris.
I'm just trying to remember. It was clearly a small minority of the room that tried it, but clearly large interest in it, and for a whole the reasons that we all know very well, which is it's an exciting new opportunity. It's a way to participate in the markets with other people's capital. It's a way to test your strategies for very, very low amount of money. And if they succeed, then be capitalized. So there's just a tremendous amount of value in the proposition. We're very excited about it. We love the prop space. We think it's the future of retail. And
it is. It definitely is the future of retail. And the people I spoke to there, people who knew about it, people who didn't know about it. Once you kind of explain to them what it is and the benefits, you have their interest. They're locked in. They want to know more. They want to know how they can get involved. Where do I go? So it's kind of just a harbinger of good things to come for the prop space, and we're really going to see some significant growth in the months and years to come.
Yeah, I agree. I agree.
So let's talk markets. We've got a bunch of people on, and I'm sure they're eager to find out, all of the big events next week, what's happening, this week. I think there's a lot, regardless of whether you're trading a prop account now or you're looking to trade it in the future, these type of big news weeks is something that everyone could learn or do a better job of learning how to trade, how to turn that volatility in those big events into opportunity.
Right. So, Kathy, before we get started, so people will know, and I know I bring this up every time we chat, where could people go to find this news? Because people need a start to finish plan. Where should they go? Where should they be looking for news?
Well, it's a very important question, and I'm glad for you to be asking it every single time, because people struggle with finding, the events that are on the calendar, what's tradable, and most importantly, what is the outcome when it's released. So step one, every single week, you should be looking at what are the big events in the week ahead. And there are a variety of calendars. My favorite is dailyfx.com. Boris's favorite is tradingindicators.com.
Yeah.
But they pretty much cover both information, all the information that you need to know. You can filter on both calendars by the high events, which is typically the events that are the most market moving. So step one, go to those calendars in the week ahead and look at it. Also on my Twitter, which you see the handle at KathyLeanFX, I just posted, a little while ago, the list of main events that are happening in the week ahead. And I do that every single Friday on my Twitter. I kind of walk you through what are the main events that are on a calendar that you should be watching. So, I do that on Friday. I do that on Sunday as well. So even if you're tuning in Sunday and you want to check what's going on, check my Twitter. You've got the big events. Okay. So now we're on Monday, or we're in the days when we have the big events. How do we stay on top of the outcome. How do we know when the numbers are released? If it's a fixed number, usually the economic calendars will update and it'll flash out the fixed number. If it's a rate decision, which we've got quite a bit next week, obviously it comes with comments and things, sentences that are important. So the best way, and even if it's non-farm payrolls, the best and fastest way to get the release is really on Twitter. Twitter is lightning fast. My favorite, you just really need to have a couple of feeds. Like I like News Squawk, Investing Com, and Forex Live. And even if you subscribe to like Reuters, Bloomberg, I'm sure they're right on top of it. But just at let's say non-farm payrolls day at 8:29, log on to Twitter and wait, because when it hits 8:30, they will be the fastest. And not only that, it's like you get not just the number, but oftentimes you'll get the interpretation very shortly thereafter. So you don't need to guess yourself. And this is even more important with central bank rate decisions, where, like I said, these people are dissecting the lines in these statements, and they're doing a better job than you are. They're doing a faster job than you are, and so they're just going to tweet out the most important takeaways. So that's how you get the outcome. So step one, on Sunday, or make sure you're kind of aware of what's coming out in the whole week. Day of, kind of look at the expectations on the calendars, and then go on Twitter to get the outcome, and to get the interpretation.
I'll just add one thing to that from just a technical point of view as a hack. If you use TweetDeck, so let's say if you're trading news or you're watching news on your desktop using TweetDeck, you can create a column in TweetDeck that's just news only. And what I would recommend is literally just those 3 handles, so that you don't pollute the column with anything else, but just straight up news release data. And that way you will just they'll replicate each other right away at the 8:30 mark or whenever the news is released. And you can just look at that column and be fully informed as to what the news is at that point.
I am happy to show my TweetDeck. If you want me to share screen real quick, because
please.
Absolutely right. If you got other things that you follow for your personal stuff, and your feed's going to get diluted, right? It's going to get diluted quickly by miscellaneous stuff about cars or sports or whatever. So you want to have a focused feed for the things that you're following. So this is my TweetDeck, and for those of you that are on Twitter Spaces, I posted a YouTube link showing we can watch for us.
Everybody on Twitter Spaces, come join us on YouTube link, because we're going to share charts. We're going to do a lot of all the visual stuff. So make sure you just join us on YouTube, so you can get a visual as well as the audio of the show.
So I'm showing my TweetDeck, and you can see, I think pretty much, as Boris said, everyone who's serious trader should have a TweetDeck. And my first one is my aggregated feed. Then I like Forex Live, News Squawk, Investing.com, Zero Hedge, and then Reuters. And so pretty much in the first 3 second and third column is where, anything important, I think, will come through almost instantaneously. And then I've got a whole bunch of other stuff, like, I like to travel. I got Johnny Jet here. But, if there's other people who don't tweet as often, that have interpretations of the markets that I like to follow, like, the Federal Reserve, who might be posting their own stuff, they will come through in my mainstream. Whereas for speed, I look at Forex Live, News Squawk, and Investing.com.
Yeah. I mean, Kathy's layout is as perfect as you can get, because she doesn't even aggregate them all into one column. She takes them into 3 separate ones, so you can really see it. If this is a great layout for somebody who wants to do news trading, because this is where all the information really gets disseminated very, very quickly.
I think this is relevant not just for news trading. I mean, if you're just watching, even if you're not news trading and you want to know what the FOMC announcement is, whether they hike or not, I think it's absolutely important to have a couple that are very fast and thorough.
This is like the a very distilled down version of just the facts.
Yes. Well, that's what we want, right?
Absolutely. Yeah.
That is my partner in a nutshell.
Yeah, now you see all my BS stuff coming through, like, boarding area, that for travel stuff.
Right.
So that's where you can have your fun feed that you're watching, but you have your serious ones right next to it.
Right. Yes, absolutely. And that's a really, really great tool. It's free. It's fully functional, and you can essentially replicate the Bloomberg experience for literally, no cost whatsoever. One small correction: it's not trading indicators, trading economics. Trading indicators is a completely different website, but trading economics, very, very good website for big macro aggregation. The other one that I like is myfxbook.com. Great calendar. It depends whether you find it useful or annoying, but you can actually get it so that it will pop. It will actually alert you every single news event in the world, and that could get a little bit tiring, especially if you have your watch and it's buzzing your watch all the time. But it certainly is very good at just making sure that you get all the data set throughput right there. So
nice. Thank you for sharing those. Okay, perfect. So we've got where to go and what to look for and how to get that news. And now let's talk about the upcoming news. I know we've got a very busy week next week.
Yeah, we have 3 central bank. We pretty much have everything under the sun. We have 3 central bank rate decisions. We have like 3 job reports, I believe. We have inflation numbers from parts of the world, and we have consumer spending numbers. So basically, the 4 main buckets of things that are important is coming out next week for, obviously different countries. So, the most important, is going to be FOMC, the Fed rate decision. We've been waiting for this one. We've been talking about it for weeks. And then the European Central Bank rate decision, because, they are uniquely hawkish amongst their peers. The non-farm payrolls report, obviously. And then the inflation data from the Eurozone. So, those are the most important. But, like I said, there's 3 rate decisions: Fed, Eurozone, Australia. And then we've got US, Canada, New Zealand releasing jobs, inflation from Eurozone, Germany, Switzerland, spending reports from Eurozone and Germany and Australia. And then we have what I call the leading indicators for non-farm payrolls, which are the ISM numbers, ADP, Challenger. So it's, buckle up your seatbelts because it's going to be a roller coaster ride next week. I think
that's a lot of info. Absolutely.
We've been waiting for volatility to pick up. And I think this, is when it could happen.
Excellent. And do we have any predictions, any expectations for these coming numbers? What are you guys looking for? What kind of reactions do we expect?
I think we're both in consensus. Fed goes 25 basis. I don't see any other possibility. I think something was it Fed funds futures like 88% priced in. Whenever they're like above 85 or something, they're almost never wrong. So I don't think there'll be a surprise on the 25 bips. I posted today on Twitter that I think what's happening with inflation is the following. It is not sticky, but it's coming down very, very slowly. So, we are probably next, PCE came in at around 4.2 versus 4.5 period prior. We could be moving towards the 3 handle in the next period, but it is a slow grinding road. The one thing that I think is super positive from an inflationary point of view is that oil just remains in the doldrums, thank God, at around 74. I'm sort of very, very conditioned to look at gas prices everywhere I'm at. I was, when I was in Vegas, I was looking at them just simply because I think that's the number one variable for global consumers, or U.S. consumers especially, as to, how they perceive price pressures. So I think price pressures have definitely stabilized, but they haven't clearly, cratered to the downside. At the same time, demand still remains quite robust. You see corporate earnings, 80% of the corporate earnings on the S&P 500 have been in line or better, which is, I think a surprise. And I think the whole, there's been no funnier, worst call macroeconomically than the call for the U.S. recession, which they've been calling for it since 2021. And they may be calling it for the next 10 years. It kind of reminds me of every bear that went short the Dow at like 8,000 and refused to give up, even as it went to 10, 15, 20, 25, 30, 40. It's like every macroeconomist is the Robert Prechter of the forecasting world, in my opinion. So for now, I don't see the risk of recession. And I think the Fed doesn't either. And that, unfortunately, that's not great news for the market. Although it'll be interesting to see if the tonality of the Fed will change. If they will say, we're really, we think we are close to a closing on the terminal rate. I don't know. What do you think, Kate?
I think the tonality is really key because the the rate hike expectations have actually been paired in the last 24 to 36 hours. They're still pretty high levels, but with the First Republic Bank, kind of debacle and the turmoil that's happening in the last 36 hours or so, there's a lot of some Fed watchers are starting to think that maybe they will pause. Now, I think Boris is right. Both him and I are under the consensus that they're going to raise rates by 25 basis points, but this really ups the chance of them, saying that, or suggesting. They're obviously not going to say it. They're going to suggest and imply that they may need to watch how things progress before taking additional action, and basically shift to a slightly less hawkish, maybe neutral stance, and suggest that at the next meeting they could pause interest rates. And so I think that is the greatest risk, because today we've had a significant dollar rally, and that's really something that they're walking into. And Boris talked about the inflation front. The PCE numbers that just came out this morning were stronger than expected. So I think that they are starting to get a little worried about the consumer end of things and the effect of all this stuff. And so a lot of the work is kind of being done for them already in the financial markets by the dollar movement. And so I think there's a very good chance the guidance is going to be dollar bearish and be less hawkish. So, gold's been stuck in a really tight range. And I think that, we could really get some direction off of the Fed rate decision.
That would be really interesting. I think the gold trade, the equity trade, the risk trade overall is going to be very, very interesting. Kay is right that, strong dollar is by its very definition deflationary for the U.S. economy, because it obviously makes our purchasing power much greater. So that in itself is going to be supportive of Fed. I think the Fed is trying to walk that very fine line, because they're coming under enormous amount of pressure not to tank the economy into the election cycle, because that would mean essentially the Fed is responsible for the U.S. election. They will be as popular as the Supreme Court if they do that. So
Right,
I think,
right.
Another one of our great institutions that's just has an approval rating of I think 5. So the point being is that Powell does not want to go down as a goat, and he's really trying. He wants to go down as a hero, and that means trying to walk that very, very fine line. I would be surprised if he remains as adamantly hawkish as he does. I don't think he's going to turn into a dove, but I think he will. As Kay said, just any kind of tonality towards a neutral stance, it's going to soar equities and probably going to soar gold too.
And if he were to do that, it would kind of be a key shift in the monetary policy cycle. And there's very little chance that he's going to be completely clear and transparent on the next direction. And that is why it's oftentimes when non-farm payrolls is released after the rate decision, it's not as market moving, because Fed's already made the announcement, they've already said what they're going to do. Everyone, the NFP report is usually a guide to what the central bank could potentially do. So this next week we have NFP after the FOMC rate decision again. But the issue here is that the Fed will still be kind of elusive. And I think they'll still keep the market guessing a little bit. And that's what makes Friday's NFP report, I think, going to be so important, because investors will be looking at that to either cast doubt on what they're trying to tell us or reinforce what they're trying to tell us. So if they're indicating that they're pausing and the NFP report ends up softer, that may end up reinforcing that, especially, the guts of the report. And that could really trigger a durable move in the markets that lasts, for the rest of May.
These are big events. These are big events that are going to hold a lot of weight going forward.
Right.
Yeah.
And what's interesting is that, Kathy's talking about this kind of concatenation of fundamental events leading to a certain outcome. What does that show? What does that mean on the charts? That's a trend on the charts. I think what I hope people can take away from the conversation is that trend on the charts that you see, that's not a random function. That's not just a function of, somebody deciding to draw a straight line or somebody deciding to just do something. That is typically a function of a combination of fundamental events that are confirming a certain thesis, which is why even if you don't trade fundamentals, it's so important to understand them, because the inputs that are going into that little chart I think everybody likes to just, follow the chart, but they don't understand what the inputs are. But once you begin to understand the inputs, you could really, really have a much more comprehensive view of how the markets really operate.
And that's not
Definitely.
it. I mean, the ECB rate decision is huge too. Euro dollar is the most actively traded currency pair. And so both Euro and US, Euro area and the US have rate decisions the same week. So it's going to be a huge week for the Euro, especially if the ECB is, I mean, they're definitely expected to raise interest rates, especially if they maintain a very clear hawkish stance, which they probably will. Then that could really be very positive for the euro.
What do you think of, what do you think happens? Let's say we have a hawkish euro outcome. What do you think euro goes?
Well, if we have a hawkish euro outcome and we have a less hawkish Federal Reserve outcome, then, easily 112, obviously not that one day, but as time progresses, I think it could easily get above 112.
Yeah. So really a far cry from when the euro was under parity and everybody thought, it was going out of business.
It was a screaming buy at the time. I know I snapped some up. There's no way that they would let the euro project fail.
Yeah. I always find it very interesting that, people are always bearish at the bottom, bullish at the top, in the FX market, especially. So that's going to be very big. What do you think about the BOJ announcement today? That the fact that they stayed very, very dollar really verticalized against that 200-point move in dollar yen.
Yeah, we went long Kiwi yen last night, and I should have gotten long more, but obviously it was a big rate decision, and I don't like to trade right ahead rate decisions. But I'll show my charts quickly.
Yeah, please.
And give me 1 second to move my chart into the right panel. Now, okay, hold on. Okay, let me share my screen. For those of you that are in Twitter Spaces, if you want to see the chart, go to the YouTube link that I shared with you under the Twitter Spaces. Okay, so you're looking at my Kiwi yen chart. This is the chart that I drew for our customers. I trade Asia Open 8 o'clock New York time, so that was pretty much right around here. So we went long Kiwi yen. It was a short trade, but it turned out to be a really long trade into the BOJ. But we went long Kiwi yen under the premise that the new BOJ governor, which everyone's been talking about, how he's less dovish and his stance is less dovish. And so we went long Kiwi yen, which means that I went short the Japanese yen going into the rate decision. I can see it became a very, very powerful move. Now, this is not what I call a classic zip signal, because the classic zip signal is like, for example, over here, where we have the candle turn white. So in this case, the background's red. The candle turned white because it moved below the indicator line. The background represents the longer term trends. Where it is in relation to the indicator line represents the shorter term trend. So right here, I'm going to draw right here is where we have a clean, clear zip sell signal. That's clearly a very nice, beautiful trade here. Here, we didn't have that. Last night, I went long right around here, but it was still in the zip, what I call buy zone, because Kiwi yen was trading above the indicator line. The background had turned green. So long-term trend, short-term trend were positive. So that, and plus my view that the BOJ was going to be dovish. And so boom, beautiful trade. For those of you that were waiting for the pure zip signal, and you were up at 1 a.m., let's say you're one of our traders from the West Coast, or you're one of our traders in Europe or Asia, and you were up during the London hour, then you would have seen right after the rate decision. And that's really where the best opportunities come out, which is after the event, not before the event. So, because after the event, obviously they've already told you what's their plan to do, and the market, you don't have to guess. So right after the rate decision, BOJ is less hawkish, and the yen pairs, basically skyrocket. The yen itself crashes. Euro yen gets a beautiful zip buy signal. So, we've got the Euro yen above the indicator line, background's green, and the candle turns white. So this is a beautiful Euro yen zip buy signal that led to multi-hundred point, maybe not multi, but like about 150 point move in Euro yen. Now, I'll be the first to admit, I obviously did not trade that because number one, I wasn't up during the European session. Number two, I wouldn't have traded it anyway because it was a rate decision. What I did trade and what I did carry overnight was Aussie Kiwi. Nice trade to hide out.
Kathy, but before we jump to the next trade, I know you and I spoke on, I believe it was Monday, the new governor of BOJ. What kind of assessments can we make of him going forward? I know it was his first announcement. What can we take going forward from a macro perspective?
Yeah, very good question. So, why in the world did the Japanese yen crash off of the BOJ announcement? It's because he basically said that they're going to take 18 months to review monetary policy. And so that suggests that they're not going to do anything in 18 months. While he did say that we could do something within those 18 months, the market kind of really latched onto that and interpreted to mean they're not going to do anything in 18 months. Even though, inflation forecasts were raised, growth forecasts, for this year were lowered, but for next year were raised. So the adjustments to the forecast were actually positive yen, but the market latched on to the fact that he said we're doing a review for the next 18 months.
And that's why the guidance is so important. Like we talked about for the FOMC meeting, not the number so much, but that guidance is so critical.
Right.
Yeah, it is. It is really, it had nothing, we talked about last week that they weren't going to do anything at all. And so it had nothing to do with what was actually going to be the rate change. Instead, it had everything to do with the guidance. And so with the Fed, we know exactly what they're going to do. But we don't know, what the guidance will be. And that's really where the opportunity is.
Right. Now, if you guys want to take a look at how we traded dollar yen on a much more scalp basis, if you're degenerate scalp traders like we are, I can show you that construct as well. If you want me to share a chart, or if you want to, do you want to share any other assets?
Well, let me just finish talking about this chart here, and then you can share your chart. So instead, for my overnight trade, because I knew number one, that the BOJ was a big event, and number two, I didn't really want to be in a dollar trade ahead of the big PCE report. So instead, I saw a beautiful double zip sell signal in Aussie Kiwi. So it's kind of like the trade you can the hideaway trade where I hid an Aussie Kiwi. There was no Aussie data, there was no Kiwi data. We had pure 2 zip sell signals, which are the white candles that you see in this chart here that I'm pointing to. And I woke up and boom, very, very beautiful, nice, consistent, steady downtrend in Aussie Kiwi. So, this indicator, this is my zip indicator. It's available as a member of BK. And if you are taking a Surge edition, you will have access to the zip indicator and, what Boris does and my trade ideas for a month.
Yeah, that's right. All Surge traders who take an audition get 30-day free trial to BK Trading. Definitely take advantage of it. You can find it on the website, in all of your email literature, as well as the BK website as well.
All right. Okay. Boris, you want to show your charts?
Yeah, let me share my charts. Share screen. Oh God, I always hate this. Sorry, I gotta move my. Okay, here we go. Sure, that's great. Okay, so just to kind of give you a different flavor, a different take. Kathy is obviously a discretionary trader. She uses her indicators. She uses a sort of a synthesis of fundamental technical trading, and she's a classic, macro trader with entry, exit kind of stuff. What we do is much more scalp based, intraday trading based, and all of it is kind of algorithmically driven. So we have an algorithm in our chat room called Bounce, which those are people who trade with us, use quite a lot. And if you're a VIP member of BK, you get access to that indicator completely, that algorithm completely for free. But what we discovered, this algorithm we use for trading equities on an intraday basis. But we also discovered kind of like a side benefit of it is it's a tremendously valuable, really useful tool to trade news. And the key to trading news with this algorithm is the following. We need a red banner news. So that means important piece of news, one that has like a red banner on the calendar. Obviously BOJ rate decision falls into that purview. And the second thing that is very helpful, not necessary, but really helpful, is it's got to be a surprise. You got to have massive move on the news candle, right? So of course, I mean, you couldn't have more of a massive move. It's a 100 pip move on a 1 minute candle in dollar yen, right? So that's very, very complimentary. So once we have those two factors, the algo goes to work. And the way it goes to work is the following. I'm actually going to go into replay mode to show you. So here we are right before the news event happens, right? And the bounce indicator and the bounce algorithm essentially create a playing field, a daily playing field of price action. And it has certain rules that it follows. The upper line, the green line, is the 24-hour daily high. The lower is the 24-hour daily low, intraday low. This is the standard Forex CFD day of 1700 hours New York to 1700 hours New York, 5 p.m. New York, prior day to 5 p.m. That's the standard protocol for a day in the Forex market. And then we have also obviously the middle line over here, which is a little bit thin. But yeah, I just don't have it marked up a lot, but you can see it. But basically, that's the play of field. And the assumption is the following: if the price is above the middle, it's an uptrend. If the price is below the middle, it's a downtrend, right? The red, green sentiment changes are sentiment changes within the uptrend or the downtrend. But for this particular new setup, we ignore the sentiment changes. We don't care about the sentiment changes. We use them for other strategies. All we care about is if we're above the midpoint and the candle is green, we're buying. We're buying post news. That means positive trend, positive position on the intraday chart, positive price action. So the way we would do this is, and I'm going to run you through, and again, it's not for the faint of heart, but it is kind of a lot of fun. So here we are. We're looking for the 12 o'clock. Boom. So let me just sort of stop it right over here. 12 o'clock midnight New York entry, right? Now, typically, we trade only for 10 pips. We're scalping for 10 pips. So it's 10 pips up, 10 pips down. So the target is 10 pips, stop is 10 pips. And that's an insanely tight target stop for high volatility event like this. But it doesn't matter, because what our algorithm does and what we do in our strategy that I think is unique is that we don't give ourselves just one chance. We don't even give ourselves two chances. We don't give ourselves three chances. We give ourselves 4 chances for success with every single trade. Now that may sound, really crazy, but what that does is it moves our winning rate from like 65 to 70 to like 99.5%. Because by giving us 4 chances in the right direction, we're able, especially with the help of a very, very fast trading algorithm, get ourselves into the flow of the trade. And by the way, this is an extreme example. Most of the time, we only need 1 or 2 chances to resolve the trade. But the way it would work is we would be long here at 34.40, 10 up, 10 down. It goes up to 46, stops us out. No problem. The algo waits. The next candle is still green, right? Goes back in at 34.40, now twice the size. 34.40, 10 up, 10 down. Stops us out. Doesn't matter. The beautiful thing about algorithms is they don't have emotions. It waits. The next candle up, 34.43, 10 up, 10 down. Boom. Money. We're done. All of this is fully automated. We're not even, we're just, we're watching and collecting pips. And what, that kind of structure does is it creates a incredibly high probability expectancy on very, very fast moving news events. So it's just this is not our primary way how we trade our algo, but it's one of those side benefits. It's kind of like, sometimes you discover a drug has side benefits that are better than the regular benefits. This is sort of like the way I look at our algo. And I've absolutely love it, because every single news event we've traded this week, every single news event we traded last week, every single news event we traded the week before, winner, chicken dinner. It's been really a lot of fun trying to apply this to this methodology. So it's very simple.
Great.
Yeah.
Absolutely.
So, I don't know if you want to talk about markets, levels. I mean, I think perhaps the most.
What do you think about, you're in US 30, you trade US 30 every day. Yeah. What do you think about the US 30, and what do you think about gold?
So first of all, let's talk about equities, because I think it's a really interesting question, Kate, you're asking. Look at what's going on right now between the US 30 and NASDAQ, right? there's this incredible divergence between what you would call Main Street stocks and high technology stocks. And we've been seeing that over and over in the equity market. Just, forgetting the direction, the actual pattern here is kind of super interesting. And I think what it really speaks to is the fact that in a high interest rate environment with a relatively slow growth, technology really gets beaten up because, money is no longer free. Growth is not hyper growth. And only the bluest of the blue chip stocks are going to kind of, get all the crumbs. I'm going on CNBC a little bit later today, and I'm just going to preview for you guys who are watching. We're talking about what are the best stocks, what are the worst stocks. Pinterest, which is a very nice little niche social media company, beat their earnings, beat their numbers. Stock is down 16%. I think it's a dog, not because the company is bad, but because in this environment, you're not going to get hyper growth. And unless all the winnings go to the biggest dogs. So Apple, Google, it's sort of interesting. Even in Meta is coming back because you need incredible aggregation of customers to be able to survive in this very slow and steady environment. And by the way, it speaks to the fact as to why the Dow is doing better, because this, the standard stalwarts like P&G and everybody else, they can squeeze out a couple of margin points out of the consumer, and just they don't need to do much. They 100 basis points on a Palmolive or Ivory soap or whatever the hell they sell is massive millions of dollars to the bottom line to them, and that's why the Dow is doing better than Nasdaq. I think it's important for us to be aware of that trend. It may one of the interesting things, by the way, is that Fed on next week. If he is really dovish, I think Nasdaq verticalizes, because Nasdaq is really, really weighed down by expensive money, first and foremost. So that's a trend we should really keep an eye on. Real economy doing better than technical economy, but as soon as money becomes even remotely cheaper, that helps the tech, in the near term. Although in the long run, I still think that Nasdaq is really under much greater stress than people think. You're not going to those halcyon days of double-digit growth, may not be there unless AI just takes over the world the next 18 months. I was just watching Boston Scientific. They hooked up their little, the Boston Scientific is the ones that makes all those robots that look like dogs and they can do all sorts of things. So they hooked them up to ChatGPT, and it was scary at how good it was. Basically, the dog became almost human. It could respond to commands. It could listen to commands. It could say, go backwards, go forwards, go do this, go do that. So, yes, there is a possibility that we could have a whole brand new world 2 years from now.
Yeah, absolutely. It's exciting stuff. The AI revolution is before us.
Unfolding in front of our eyes in hyper speed form.
Right.
But, so equities, I think, are still just sort of a pause until the Fed goes out there. Same story with gold, which I think is really interesting. Let's go to a 1 hour chart on gold. What is gold? And gold is everybody's favorite disappointment, right? They're like the Mets and the Jets of the financial world, in a sense that everybody was so excited about the 2000 level, and of course it fails, and it still continues to fail. And I think honestly, and I think it may still fail. So to me, I posted a Twitter poll. I haven't even looked at the results yet. I'm actually curious. I said, when should we really start paying attention to gold? Although I didn't quite put it in such mild, nice terms. Above 2,200, above 2,500. To me, I don't think gold is truly a bullish story until it really clears all the nonsense of the historical highs. Then we might have a runaway market. But until then, I still think it's kind of a rangy market. It doesn't mean that you can't make money out of it. It's great, great instrument to make money out of it. But if you're a long-term positional, I still think the jury's still out on gold. Yeah.
And what's your opinion on it? What's your level you're looking for there, and how long?
Is it me or Kathy?
You, both of you.
So for me, again, I think I don't think 2,200 minimum. I got to see 2,200. Then I'm a gold bull. Until that point, I'm a gold Skeptic, is that the word? Yeah, skeptic.
And how about you, Kathy?
Well, I don't necessarily think it needs to be that high. I think that, we've been hovering around beneath 2100, 2080, 2100 for a while. I think above above pretty much the high back in August 2020, which I'm looking at my charts right now, is basically, highest level we've had in years. That's, you just want to up it to the round number above 2100. That's pretty much, I think where the upside really opens up. Now, of course, last week we looked at the significance around numbers and how oftentimes likes to just spike above and just to test it and break it and then kind of come back down. So I think we need to see a confirmed break of 2100. And I think that's all I need to see to open up the upside for gold. So I think we have a question here on YouTube that says, "What can happen when the news forecast equals the action?" Which I think is equals the actual number, which is a very good question because we talked about news trading, we talked about how there could be really big movements off of it, but a lot of traders are confused about what happens if the non-farm payrolls number is exactly what is expected, and my answer to that is that it's never exactly what's expected, because when you have the forecast that is shown on the economic calendar, that's the forecast of economists. It is not necessarily the forecast of traders. And so traders, oftentimes, are positioned one way going into a big event like non-farm payrolls. So even if the absolute number is the same, there's an expectation it could still, be not good enough. And that's particularly true for non-farm payrolls because we have the earnings, which is very important. We have the unemployment rate, which is very important, in addition to the headline number.
It's kind of like Boris mentioned with Pinterest. They beat top, beat bottom, and still went down. So there's always going to be something on the back end that's going to affect it more than just the estimates.
Absolutely. And that's why news is so tradable. But at the same time, maybe that's why, you may want to avoid trading news. We've got a little trick to trade news where we encourage people to wait. It's like the longest 5 minutes of their life, but wait at least 5 minutes after the data's out. Let the market dissect the number itself. By that time on Twitter, the experts would have already fed out, what they think is the takeaway. And, when after that 5 minute candle closes, then, you've got the real interpretation of the number and then ride that move. Because a lot of times in that first 5 minutes, you have up, down, sideways, complete reversals that happen. And we see it all the time, especially with non-farm payrolls. So with news trading, it pays to wait. And it's, like I said, it's the most excruciating 5 minutes of, a news trader's life. But it's the smartest thing to do.
Good point. Good point. Yeah. Well, no, I've heard that for years, and I've seen it in my own trading. The first move is the wrong move on those things.
So we have another question. How will negative interest rates affect the economy, like the BOJ? Well, negative interest rates are created to help the economy, right? To basically encourage savers not to put their money in the bank, but to start spending. It is negative for the currency because it deters big investors, global investors, from putting money into that country because they don't want to be having to pay for the benefit of parking their money there. But for an economy itself, negative interest rate is a tactic, a tool that a central bank uses to encourage their people to spend. Now, it's not always effective when you've got a reason why people don't want to spend, like COVID, for example. But and also it's a tool to drive up inflation. And that's, what these central banks use negative interest rates to do. Very good question. And I appreciate all of you posting those questions on the YouTube link.
Kathy, on that same milk, do you ever see us going into a negative interest rate here in the U.S.? I know that's quite far out there, but what are your thoughts on it?
We not at all. We haven't done it, and I don't think that we've got an environment that requires it at all. The labor market is very tight. Consumers are still spending. I definitely don't think that's going to happen.
Not in the next 18 months. Okay. Let's, you never say never in the investing world, but not in the next 18 months for sure. Yeah. And let me put it this
Okay.
way: if we go to negative interest rates, we have much bigger problems than that. But I think, I do think, coming back to BOJ and the BOJ decision, it's kind of informative of, Japan has always been the interesting laboratory test case for the whole advanced. Japan in many ways is the most advanced economy, in a sense of it's wealthy, and it has the most aged population. And to me, the fact that their population is so aged out is a function of why their monetary policy is so loose and so adamant about not really responding to high interest rates, simply because government spending needs to take care of that whole aging population. I think we're going to be operating not to the great extent, but to the same extent under the same constraints, unless the U.S. just changes its opinion on immigration. Because that is literally, we're headed. I've been arguing that returning Japanese is more than just a song. We're headed very much towards that path. If you look at us demographically, and there's no way you could really run a high growth, high interest rate economy if 50% of your population is, 60 years of age or older. If they're carrying AARP card, you're just not going to get that growth rate.
Good point.
Yeah.
Absolutely. Well,
And
I think
I think
go
that's
ahead.
representative, of the U.S., where we've got a booming younger population, and that's the really the opportunity. And so it's the parallels of the different growth opportunities for the U.S. and Japan in the next 10, 20 years.
Yeah, and by the way, sort of like the hyper example of that will probably be India. Speaking to a lot of people and a lot of Indian expats, because India, obviously a greater population than China. I think they overtook them, or they're very, very close to overtaking them. But more importantly, I think they have the greatest, in absolute numbers, the greatest middle class in the world, English-speaking country. Middle class, a couple 100 million people, very, very youthful population. I mean, if they can sort of get infrastructure and property rights and everything else organized, which was exactly what they were all working on, in a democratic society, that's a great bet, as a hyper growth bet. I mean, that's why Apple is we're talking to my producer. We're talking about Apple. Apple is a stodgy company, but they're making their next billion consumers are going to come out of Southeast Asia, and they're not stupid. They're making a huge bet into India because that's really where the growth is going to be. Yeah.
Interesting.
Yeah.
Good insights.
So that's pretty much it. We're all on pins and needles waiting for monetary officials to come and tell us their position. And in the meantime, markets are choppy, but at least a little better choppy. I think we're finally past the Easter Passover massacre that occurs every year, where we just put ourselves into a churn. I almost feel like we should just close the markets down for the month of April, reopen them when everybody's back from vacation. Because
right.
We have some lingering questions. Like one from Satish that says, "How's fiscal policy affect FX?" Usually it has in terms of market movements, it usually has a shorter term impact in terms of any type of headline impact on the currency market. I think currency investors, traders care much more about monetary policy than fiscal policy. Like, they've never taken the whole debt ceiling thing seriously, because they know it just gets raised every single time. And then we have one question, which is...
Can you just explain to people why monetary policy is so much more important to FX traders?
Well, I mean, basically, money moves from one part of the world to another in seek of the highest yield. And so, central banks determine what the yield and interest rate will be. And that's why it's so important. And then another question is, how does Euro news affect other pairs like dollar yen? I mean, ultimately, what it really is less so Euro news, but more so what's going on in terms of U.S. yields. I wouldn't say it has a direct impact on dollar yen. It obviously has a direct impact on euro yen, euro pound, euro Aussie. But dollar yen, today is definitely singing to its own tune because of BOJ. But great questions. I love all these questions coming in.
Exactly.
Great.
Okay.
Excellent.
Any more questions?
Well, guys, thank you so much. And I know next week, I hope you have a great weekend. And next week we have a lot to talk about.
Yes.
So we'll be ready for that. And anybody who's viewing again, you guys can get a 30-day free membership to BK Trading, BK Forex. Check it out on our website. That's all the SurgeTrader audition takers. You get free access to that, and you get all the insights of Boris and Kathy.
Great.
Right. And we'll be back at 11 a.m. chatting with Corey on Monday. So, we'll post the announcement. So please join us.
And we'll gear ourselves up for a very, very heavy data week. Yep. Thanks, guys.
Excellent. Looking forward to it.
Bye-bye.
Thank you, guys.